Hi, everyone. Welcome to another crop insurance webinar. Today, we'll be doing a crop insurance price estimator walkthrough. For this price estimator, we're going to use a fictional farm as an example. So this fictional farm I've set in Logan County, Kentucky. I've put the total revenue as $23,400. And this farm is growing 1 acre of peaches with a revenue from peaches of about $6,900, growing an acre of pumpkins at a value of $7,500, and then an acre of strawberries at $9,000. And so I got these prices. I used just acre average for these commodities. And then I use just average price to kind of guess on a price for some of these commodities. So they're not exact, but they'll do for this example. And for our example, this farm is going to be selling their commodities fresh and not processed. They'll be using conventional methods, and it's one grower or one entity that's operating this farm. And it's on grower-owned land, so not rented land. First, we're going to use this RMA Commodity Program Finder map. So I'll just go ahead and open up this map. And this map is useful in seeing if what kind of crop insurance policies are available in your county. So if you'll remember, we've talked about before the multi-peril crop insurance policies, or MPCI. These policies are commodity and county based. So you will use, you have to be able to have one of these policies. Your commodity has to be covered in your county. So if you were growing tomatoes in Christian County, there would need to be a tomato policy in Christian County for you to have coverage. This map is taking a little while to load, so I'm going to retry that. Well, it looks like the map is not cooperating, so I will, I do have these, some screenshots from these maps. So basically with the maps, you'll select your commodity year. So I chose 2022 so we could have the most current display of counties available. And then you select commodity. And so I selected soybeans, a row crop, just to show you the availability of some of these larger cash crops. So commodities like corn, soybean, and tobacco are available in many counties in a lot of states. So in Kentucky, you can see, I'll circle it here for you. The western and central side, soybeans is available in every county. And next, tomatoes. So I selected a common horticulture crop you see at farmers markets, you see at roadside stands. So of course, there's got to be a ton of counties with tomato policies, right? Well, no, it's some in California. There's several in Indiana and Michigan, a couple in Ohio, and then some more up in the Northeast. But there's no counties with MPCI tomato in Kentucky. And then what about some other common horticulture crops like strawberries? Surely there's some in Kentucky, but no, it's California and Florida, and it's still only a handful in those combined. So it's those row crops are usually large operations growing on many acres. So with some of these horticulture crops, typically it's not a ton of acreage in each county in those crops. So that's why it's rare to find counties with some of these horticulture crops. So pumpkins, those are something you see in the fall everywhere, and there's tons of growers in each county. However, there's only a few counties in Illinois in the whole US that have MPCI for pumpkins. And finally, there's peaches. So this was the only one I was easily able to find that had coverage in Kentucky, and you can see it's only 2 counties. It's Warren and Logan counties. And so you can see that's why I chose Logan for our example, because I am going to go through the price estimator with Logan County on peaches. And you see right here, it says plans APH. So what does APH stand for? That stands for actual production history. So that means in order to ensure your yield, they'll look at your own past records. So they'll look at your own past yield of peaches on your acres for 5 to 10 years. Now, a lot of horticulture crops that have availability in other counties and other states are typically done through the APH because, like I said, there's not many growers in those counties. So they need to go off the own growers' data. A lot of the row crops like soybean and corn, those plans will be called like county average yield or county average price, or even estimated price or estimated yield. So those go off of county historical data to either say this is what your yield should be based on your acres, or this is what your yield should be based on surrounding counties. But with the horticulture crops, it goes off your own. So that's why it's important to keep your own records. So next, let's move on to the USDA RMA Price Estimator. And I will put this link in the chat at the end of the webinar, and we'll put it in the description of the video once it's uploaded. So let's go to this price estimator tool. This is done by the USDA Risk Management Agency. Those are the people that write these policies. So they're the ones that choose which commodities are available in which counties. So I'm going to start by selecting our commodity year. I did 2022. Insurance plan, we're going to do APH to start with. So that is for our peaches in Kentucky, in Logan County. While that opens, I will say there are a couple different commodities that do have APH plans available in Logan County. So there's a couple tobacco crops, hemp, and then also peaches. So we'll select peaches and click add item. Okay, and I'm gonna click this 2 more times because I want to give us a couple examples. So in item 1, we're gonna use our fictional farm we talked about. So these top few rows, we can't really change those for peaches. It doesn't allow us. There's no option. But here, so in item 3, I'm going to use organic prices. We're going to say for this example, this item 3 is a farm that is organic. We'll keep them selling as fresh, but item 2, we're going to select as processing. So item 1 and 2 are going to be conventional methods, with 1, our farm, being selling fresh peaches, and item 2 is going to be selling processing peaches. You can see it's already chosen a unit of measure for us, so bushels of peaches. And then down here, it gives us the price. So you can choose which price you want to sell at, but for this example, we'll just go with the 100% of the price. So for conventional fresh, that price is $38.45 per bushel. For the processing peaches, it's $30 less. So it's $8.20 per bushel, conventional processing peaches. And then you can see down here at the organic, the price for 1 bushel is $81.13. So we'll leave those all at 100% of the price. And then for reported acreage, we're going to do that 1 acre. So we'll leave, we're not multi-cropping this. You do have the option to select beginning or veteran farmer. But I tried this a couple of times, and I don't know if it's with the peaches or for whatever reason, it didn't really affect our results, even though I know for sure in the past that several different commodities do have benefits for beginning or veteran farmers. So approved yield, well, I chose 180 bushels for this 1 acre. I think an acre average is about 177. I just rounded it up to be simple for this example. Rate yield we'll leave blank. That is if we needed to substitute records. So maybe you purchased the farm from someone not too long ago, and you want to use their records, their yield records, to apply for crop insurance. But we'll leave that blank for now. The insured shared percent. So we're just going to put 1 because we own 100% of the farm. You know, if you had a partner, you would put 0.5 if you split 50-50. But we are 100% with this example. Next is unit structure. So I'm going to swap all of these to basic. That means I don't want to split my operation into units. So I could leave optional and then select optional unit numbers based on how many sections I wanted to break up the farm. So if I had half my field as irrigated and half non-irrigated, I would, have 2 units. I could choose up to 3 units if maybe a corner of the field I had a lot of trouble with and I wanted that one insured a little differently, I could do that. For a basic unit number, we'll just leave it at 1 because it's only 1 grower. If there were multiple growers, you would select, however many. You would get a point for each. And then if you rented the land, you would put a number based on that because you don't own the land. And I'm going to click Get Estimates, and we'll give it a minute for it to hopefully work right and give us our prices. But while we wait on that, I'm going to come back to the first page, and we're going to select whole farm revenues so we can look at those prices as well. And it left Kentucky and Logan for us. So we'll just click on, and we'll go through the same process. Now it will be a little different based on this policy. So it does give me the option to choose Microfarm. So I'm going to click yes. We're going to compare Microfarm, which is the new policy. It's same as whole farm revenue, but it's for operations under $100,000 in revenue. And so this farm is $23,000. So we would qualify for Microfarm. But we're just going to compare these two for now. So we'll leave all this blank. Or leave it the way it is as regular calendar year filer. It doesn't give us the option to select organic practices, so we'll leave it as conventional. It probably doesn't matter with these because it's not looking at prices, it's looking at your revenue, so it wouldn't matter which methods you use. We'll leave the rest blank or as no. I'm going to change the whole farm to no on expanded operations. So we're not going to try to guess what our growth will be. But it's nice that it allows you, if you can prove you've had growth that's pretty steady over the last couple of years, you can choose to insure at your projected price or your projected revenue. so that you can protect that. But we'll leave that blank for now. We'll say no. And now down here is where we will input our revenue for the past 5 years. The years are off here, but I'm going to use the same numbers in each and not worry about the year on the side, just so we can more easily compare the prices. So I'll type these in really quick. Okay, and the same for the whole farm. We'll just use the same numbers. So this farm is one that's had a little growth over the past few years, maybe due to price change or price increase. But once that's done, we select our commodities. So with the microfarm, there's only one commodity choice, and that's microfarm. So the great thing about microfarm policies, you're not having to record all of your separate commodities and then tell their value. You're just, they allowed microfarm to be created as a new commodity code. It's got its own code, and you just select that and put your value, your revenue for that, your whole farm. Now for the whole farm, we'll have to select each individual crop. So I'm going to go through, I'll select fresh market peaches, we have pumpkins, and then strawberries. And then it wants us to record each total value for those. So I'll go through and do that real quick. So 6,900 for peaches, 7,500 for pumpkins, and 9,000 for strawberries. The rest will all leave the same, and I'll click Get Estimates. While that works, let's go take a look at our peach prices. So you can see here, this is showing your liability amount based on each farm example, and then based on the coverage amount you select. So for item 1, this is our fictional farm we're talking about. 85% liability is for the $5,883, which is 85% of what our total yield price would be. And you can see the comparison between the different ones. So this was, number 1 was our conventional fresh, 2 was conventional process, and then 3 was organic fresh. And let's take a look at the premium amount next. So this is how much it would cost, the premium is for these policies based on the coverage level selected. So for farm number 1, 85% coverage, your total premium is going to be $1,143. For the organic, it's over double that, so $2,400 or so for the 85%. Now those can seem like a lot, but let's look at what the producer would actually pay. So for the 85%, we've got $1,100 is about the total premium price. So the producer is only paying $709. So that's not half less, but it's a good chunk gone because the government does give you that subsidy. So you can see at the 85%, they're paying $434. For all of these, it's about the same percentage that's being covered by the government. You can see around 75% is where the subsidy is more than what the producer is going to owe. So once you get to 75% for this first farm, the producer is paying $375, while the subsidy is $458. So it's really not bad to protect 75% of your operation you are not paying as much as the subsidy is. So it really is worth it for a lot of farms because you're not spending as much as you would have without that subsidy. Now let's go take a look at our whole farm and micro farm. Sorry. So you can see if we selected 85% coverage for our $23,400 revenue, 85% would be protecting $19,890 for both policies. So the coverage amount is the same for microfarm and whole farm revenue protection. What is different is the premium amount. So you can see here, the microfarm 85% premium is $2,400, almost $2,500. For the whole farm revenue protection, it's almost $2,200. So there's about a $300 difference or so, $300 about, and that's the case for most of them as you decrease in coverage level. So that might seem like a lot, if your total revenue is $2,300, you'd be spending, almost $2,500 to get coverage to protect 85% of that. But it's really not bad in the long run once you look at what the producer is actually paying. So for that 85%, we started out at $2,400, and the producer will only pay about $1,000, $1,100 or so. For the whole farm, it's $2,100. Producer is paying $963. So it's really less than half, because with the whole farm and micro farm, the subsidy is over 50% of the premium. So no matter which coverage level you selected, the subsidy is going to be greater than what you're paying. So why would you choose not to, insure that percentage of your revenue for, really not a lot at all? You can see at 85%, you're paying $1,000. At 80%, you're paying $635. And then after that, all of those are below $400. So it decreases greatly. And another thing to note, I wanted to compare the premiums with the whole farm and the MPCI for peaches. So remember, the MPCI is just covering peaches, but this whole farm is covering peaches, pumpkins, and strawberries. And out of those, peaches had the least amount of revenue of the three commodities for this farm. So for 85% whole farm is $2,188 for the premium total. For the peaches, 85% total premium is $1,100. So over half, or it's almost half of the cost for three commodities versus the one. So unless you're strictly growing peaches, this would probably not be the best choice for you. You would want to go with the whole farm. And so that was just a quick walkthrough. These prices may not be accurate. You need to talk with an agent to make sure exactly what it was. Sorry. And to finish out, I just want to go over the crop insurance webinar schedule coming up. Real quick, if you've got any questions, drop those in the chat. If not, we'll go through this schedule really quickly while I wait for y'all to type those in. So our next webinar will be a grower panel on May 10th. We'll talk to some growers who have experience with purchasing or dealing with crop insurance, a variety of programs, not just one. After that, in June, we'll do a Q&A with an insurance agent again. So if you've got questions for the grower panel or the insurance agent, get those emailed to us so we can ask those participants. And then at the end of June, we'll have a video on some other types of insurance that's not crop insurance that growers may need. So we'll do a quick run through of those. And again, like always, our funding acknowledgements, thanks to the Southern Extension Risk Management Education Center and the USDA National Institute of Food and Agriculture. They provide funding for these webinars and videos. And I don't see any questions, so I thank you for coming to this webinar. We hope you learned something. If you have any questions, email us. My email is dakota@kyhortcouncil.org. Thanks.